What's up, everybody? Welcome back to Earn It, Save It, Invest It. This is week 33 of my $100,000 challenge. So I'm going to go over my portfolio, what I've done, what I think the stock market's going to do, what I think my positions are going to do, what I'm going to add, all that good stuff. And also part two of this is I'm going to show you how you can take your portfolio from just a few hundreds of dollars to thousands of dollars. And it's so simple, very easy, very cheap. Anyone can do it. Everyone should be doing it. So I'm just going to go over that really quick at the end. This one's going to be a little bit of a faster video. I have a hectic day, so let's just jump right into it. If you can, I would love a like and subscribe if you can. I appreciate everyone who does watch these videos, likes and subscribes, all that stuff. So let's get into it. All right, so this is my $100,000 challenge right now. I am currently at $8,835.68. My top position is TQQQ, as well as HIMS, Celsius, Meta, Amazon, Fubo, Nike, Adobe, The Trade Desk, and Hasai. TQQQ is going to be it's going to be a top dog for a long time, especially when it really goes down. When TQQQ goes down about like 50%, because eventually it will have a 50% drawdown, I'm going to buy heavily into TQQQ, and then my shares, and that's going to go up anyway. But HIMS has also taken a hit. HIMS was a big one that took quite a hit for me. So over the last week it's down 8%, right? Same with Adobe, is down 10%. So those are some stocks that have hit my portfolio kind of hard. So to go over where I'm at exactly, week 33, I should have been at $10,000, right? This is where I would have been if I'm just growing at a 20% compounded interest yearly rate, right? So this number is never going to go down. Everyone who has done any investing in the stock market knows it's never just going to go up. It's never going to go straight up, and it's never going to go straight down. You're going to have these bumps, right? So on the left side right here, this amount right here is all going to just continue to go up. It's never going to go down. It's not like it's fluctuating. It's just continuing to go up. This is obviously my current balance. I went down 1% for the week. My goal, compared to my goal, I'm still behind around 11%, almost 12%. Since June 2nd, though, I am still up 20% on my portfolio in total. But at the same time, if we take out my $50 deposits, I'd actually be down 1.5%, right? So those $50 deposits really made a big difference. Now, obviously, I'm still down in terms of my money, but the fact that I've been making these little deposits, and it's going to be giving me the ability to have this cash for later on, or it's allowing me to invest into stocks that maybe not doing great now, but will later. That extra money will do a lot of good. Watch. AAII Sentiment Investor, this is the survey. So as you can see, we have just been on a bull run, right? Since Christmas, basically since Thanksgiving, but definitely since Christmas, we have just, look, 37.4, 42, 42.5, now 49. Almost half of the investors believe that the stock market is going to be bullish over the next 6 months. I believe over this next 6 months to a year, it's going to go up. How much it's going to go up, I don't know. This definitely feels like pretty heavy, but at the same time, if everyone was just like, well, the stock market's going to go up, it's not going to go up a lot, I don't think it's really going to go down. If everyone was saying what sounds reasonable, that would be at 100% bullish, right? So no matter what, you need your bears with the bulls, and then the neutral, right? The bears have kind of been stuck right here between 27 and 30%. They haven't gone anywhere, as the bulls have just continued to run. Here's the week special question. Relative to your expectations at the start of the year, how did your portfolio perform in 2025? So people will say it performed better than they expected, much better than they expected, close to how they expected, and worse. So obviously a lot of people had a good year. So will people still have that feeling and sentiment going into 2026? So far it kind of looks like that. Fear and greed index. We are now getting greedy, though. It's very funny how there are some times where we were going into fear. This was a year ago, but a little while ago we were neutral and even into fear while the AAII sentiment was just continuing to go up. So these were kind of at different directions, right? Now we have greed and the investors are all saying bullish, right? So now we have both of them going kind of in the same direction, which to me could signal maybe a little bit of a pullback here over the next month or so, because if we just have the investors saying, yes, 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 let's go, 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 this is more about the emotion, right? This says right here, what emotion is driving the stock market? So greed, right? So if we just have greedy people and we have investors saying, yes, 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 it's good, 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 like something's going to break, right? And all it takes is one, if you have an unexpected event or an unexpected situation, whatever it is, the impact is bigger if you are more the other way, right? So if everyone is getting bullish and getting greedy, and then there happens to be a surprise that's on the downside, even if it's minor, it could react major, right? Because all the market's going one way, all the market's going up, everyone's being positive, and if you just give a little bit of negative sentiment, that might crash their whole philosophy of what they were thinking of over the next 3 to 6 months, which is kind of crazy. That's how the stock market is. But you just want to look out for that. When everybody is acting greedy and everyone is acting bullish, you might want to start looking a little bit on the bearish side. Doesn't mean sell your stocks. It doesn't mean anything like that. It doesn't mean to really change your strategy other than maybe buy less, right? When people are getting really greedy, maybe buy less so you have a little bit of capital for when things go bad, you can then buy some, right? But you always want to keep investing, keep buying a little bit, right? So that's that. I'm going to kind of, like I said, wrap this up as fast as I can. So this is, I want to go over how you can take your stock portfolio from just a few $100 to literally tens of thousands of dollars. And it's not a joke, and it's something so simple that people can do very easily. So based on the data as of mid-January 2026, the S&P 500 has grown significantly over the last 2 decades, right? The SPY is a index that tracks, it's an ETF that tracks the S&P 500 index. So basically where the S&P 500 goes, so does the SPY, right? It's basically linked, almost exact. SPY used to be $125 to $128 per share on January 1st. It was just about like 125. I think it was just under 125. So let's just say it's 125. Today it was $691, right? So if we take, and let's just look at this, right? This is a great website to visit. It's called totalrealreturns.com. And what you do is you type in the stock. I have SPY. And it's going to show you the real returns, right? You can do dividends reinvested, yes. You can do inflation adjusted, yes, right? You can do all these different things to figure out how it's grown. And over the last 20 years and 15 days, it has grown about 400% at around 8 or so percent a year, right? Now this is again with dividends reinvested, all that stuff. So let's just go with 8%. And like I said, it was at 125, right? It's at 125, it's at 691. So now look, let's say 125 over the last 20 years, and you get around 9% return. It gets you at around 700, right? $700. And you've contributed zero. Now just imagine you bought one S&P 500, right? Just one SPY stock. Let me zoom in on this. You buy one SPY stock for $125. 20 years later, it's worth $700. And you're thinking, that's kind of cool, right? But 20 years and I gained $575? Okay, fine. 125, let's just say it was $500, right? Okay, so now you're at 2,802. You're still like, that sucks. Well, let's be real, right? If you had to wait 20 years and you put $500, I mentioned you $500, you never touched it, right? This is how much you will contribute, how much extra money you're going to contribute, and you contributed nothing. You had 9% return, on average every year. You had 20 years to save for, and you did $500. You'd be at $2,800. Now, cool, right? But let's go back to 125. This is where you'd be at if you just bought one piece of S&P 500 now, or SPY, sorry. Now let's say per month, I want to zoom in. Per month. This is not per week. I do $50 per week. I'm going to do $50 per month. Everyone, I mean, Netflix is almost there, isn't it? I mean, if you have Netflix and Amazon and something, I mean, it's easily, your subscriptions are well more than $50. I think everyone can afford a $50 per month investment on themselves. Now let me show you what $50 per month does over that 20 years. And you might think it's insane. There's no way. But the point is, yes way. This is simple math. It's just math. $50 per month instead of $700 after 20 years. You get $31,000. Imagine. Instead of, now granted you did invest more, right? You still only got your 9%. But if you invested $50 every single month, you would have this much. Now remember, this is the SPY, if you were buying individual stocks, if you saw the stock market crash completely, right, in 2009 and 2020, and there's certain parts, 2018, there's certain time periods where the stock market's crashed pretty heavily. If you had picked up a little bit more of those individual stocks, your return would be more. This is kind of like a bare minimum, right? Like a 9% return on an index fund or an ETF is pretty standard. You're saving for 20 years. You started with $125. You just put in $50 per month, and now you have $31,000. Again, it's 20 years. I get it. People might be like, oh, 20 years, the $31,000 is less than half of my salary I make per year. Okay. Let's put 100. Let's start off with 500. Okay, it doesn't do much. And let's say you pick some individual stocks. You picked a few that were like, you know what, I know these are going to good. I'm going to go, right? Actually, let's do this. As if the SPY is, what was that? 8 to 9%. So let's go Amazon. All right, we're going to do Amazon. Oops. Same time frame. Right? We're going to do the same time frame. Their return over this 20 years has been about 22%. 22%. Do you want to see what that looks like? You want to see what just $0. Let's do this again. Let's do this. $125, 20, and let's just add up to 20. Let's go to 20, not 22%. Right? Look at that. That's insane. Now, let's say you had your 20% and you invested $50 a month. How are people not thinking this and doing this? Now, granted, it's 20% per year, which is not the easiest to come by. It was an Amazon stock. It's an Amazon stock. But you can go through countless stocks. I can just start going down the list, and a lot of them can perform, give you a 15%. Let's go 15%. Let's go $0 a month. Let's go back to that. Let's meet in the middle. Let's go 14%. It's kind of more meet closer to the bottom, a little bit more conservative, right? Now, say you invested $50 a month. More than double, or just about double, right? And that is starting with $125 and $50 a month. I know kids who can do this. So, you know, and some people might look at this and say, after 20 years, I have $56,000. And what am I doing? What am I doing? Let me show you what you're doing. Let's say $56,000 over the next 10 years. So now you went from $125, $50 a month, to now $219,000. You waited 30 years, granted 30 years, $50 a month. That's so, could you imagine what a $50 a month bill is going to be like in 30 years? Right? So, I don't know. to me, this is the easiest way to not get rich quick, but to, to climb up the ladder a little bit, right? That's just, I don't know. It looks pretty amazing to me. So just really quick to end this, because I do have to go. This is the market over the last week. Technology did pretty well, except for Apple. In terms of it says in department is electronic technology. This is technology services, right? So the services is not doing well. We have Meta, Palantir, Netflix, Microsoft, Salesforce, AppLovin, and we have all this. Intuit, ServiceNow, all these people that went down. It's pretty red. Same with finance. Finance didn't do so good. They released their earnings, and as you can see over the last week, didn't do so well. So that's a little interesting. Health as well, right? HIMSS sucks. HIMSS is not up here, but HIMSS hasn't done so well. And then look at this, consumer services also not doing very well, and neither is health services and communication. So there's a few that are down. Retail trade did pretty well, except for Amazon. Economic calendar, we got a few things coming up this week. We got the mortgage rates, that pending home sales, construction spending, GDP growth rate, initial jobless claims, some core PCE and personal income, personal spending, and then well, what else do we got here? That looks like and then consumer sentiment, consumer expectations. That might be a pretty big one. Friday 23rd. My birthday's on the 22nd. Woo! And so again, this is SPY really quick, just to look at kind of where I was looking at. It was right around here, and you look at people might be scared to buy here, and maybe you would have been scared to buy there. But all you can do is just do what's been proven to go right. And sometimes things will go wrong. But if you choose the thing that has worked over time more so than not, it's probably going to work in your favor. Let me just show you also really quick. It's going to show you the returns. Now this is Amazon. Let me go back to SPY over the last 20 years. Look at their returns, right? Since 1993. It's been crazy. I can tell you, just looking at those 3 years, I could immediately have told you tech bubble right there, right? Tech bubble. That was easily boom. And then, all right, one of the biggest drops it's ever had in a year was a great financial crisis. And then we have 2022, which was pretty bad, right? And one thing I want just quickly to see, obviously these are the beginning years of it. It was boosting up very well. The 90s were amazing for the stock market as well and the economy. As we got into the earlier 2000s, as you can see, it kind of staved off. It kind of stuck to the single digits to even the double digits a little bit. 23 is that's pretty good. 25, that's pretty good, right? 30, that's amazing, but we only had 1, 2, 3 from 2003 all the way up to 2018. So that's 15, depending on how you're counting it. So it's 16 years actually of only having 3 times it being over 20. Oh, actually, hold on. 1, 2, 3, right? 3 times it was over 20%. Now look at this. 1, 2, 3, 4. We've had 4 years where it's been over 20% since 2019. That's 1, 2, 3, 4, 5, 6, 7 years. 7 years that we've had, and then 1, 2, what was it, 5? So that we've had 4 out of the last 7 been 20% or more. Then we have a 16 and a 14. So the market to me is also getting a little bit more gamified. I do believe the stock market is becoming more of a gambling thing, with crypto and everyone's getting into, you can buy something at one price and then sell it at another, the whole, game cars, sports cars and stuff, right? There's a lot of that stuff that happened during COVID, and I think Robinhood with the no commissions has really made stock markets a little bit more volatile, a little bit more, the ability, it can go up a lot more, but it can also go down a lot more, right? So I think in that case, right, let's just say you have higher reward and you also have higher risk, but if I'm talking about something that more than not on a very, very consistent time frame has been rewarding, well, I'm going to go for that, right? If there's more rewards available and that I can see that this thing is giving out a lot more rewards than it does the risk, I'm going to go for it. So that's my 2 cents. I definitely think that people should be investing into their account constantly, right? Because again, if you look at my account is 20% up since June, even though if you take away all my deposits, I'm actually down. I'm down 1.6%, but I've just been putting in some money and I'm not really thinking about it too much. I'm just doing it and continuing to invest in it. I am still holding some cash for when this pullback happens, and that's just what it is. So, consistently invest into your portfolio. Consistently do that. Consistently know what you're investing into. And if you just have to, go half in ETF or an index fund, and then half just some good stocks that you know can perform at a 15 to 20% that it's shown over the last 10, 15 years that it can do that, right? And if you have that, I mean, you could literally turn $125 into $31,000, $56,000, $200,000. I mean, you can turn it into a lot. So it's just my 2 cents. Again, always be prepared and aware. Don't be scared of the stock market. It's going to be emotional. It's going to have a roller coaster ride, but it's all going to be good if you stick with it, stay consistent. So thank you for watching. Please give a like and subscribe. For anyone who's still watching at this point, I really appreciate you. Honestly, I really do. I really appreciate you watching right now. Never forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.